Well, good morning, and thank you very much for coming along this morning. I'm sure you all know Grant Spencer, who's the Deputy Governor of the bank and in charge of all the financial stability work undertaken in the bank. New Zealand's financial system is sound and well placed to support growth in the economy. The banking sector is well capitalised. Funding and liquidity levels are at comfortable levels, and non-performing loans continue to decline. However, there are several risks to the financial system that require continued focus. The level of household debt remains high relative to household income, and several measures suggest that house prices are overvalued. House lending accounts for around half of bank lending, and financial stability could deteriorate if a sharp correction in house prices, particularly if accompanied by a reduction in debt repayment capacity, were to occur. We introduced a speed limit on high loan-to-value ratio lending in October last year to help reduce this risk. Debt levels are also high in the dairy sector, although incomes are currently strong due to export prices. A reduction in farm incomes and any associated fall in land prices could place pressure on more highly leveraged borrowers in the sector. At a broader level, New Zealand remains exposed to the international financial markets due to its high external debt and ongoing current account deficit. However, strong deposit growth in recent years has helped to reduce the reliance of the banking system on offshore funding. Grant will make some comments as well.
So, with regard to the LVR restrictions, these appear to be having the desired effect of moderating house price inflation and reducing the risk of a sharp market correction. House sales are down significantly, mortgage credit growth is reduced, and we estimate that house price inflation is about 2.5% lower than it would have been without the LVR restrictions. However, we expect the restrictions to remain in place until the housing market comes into better balance. This will be assisted by increasing interest rates and the improving supply of new houses. We will also need to be confident that immigration pressures are not going to cause a resurgence of house price inflation. The earliest date for beginning to remove the LVRs is likely to be later in the year. Regarding regulatory policy, the bank will be commencing a stock take of its bank and non-bank regulations with the aim of improving the efficiency, consistency and clarity of those regulations. We will be consulting on that in due course. A further initiative is the development of a comprehensive stress testing framework for the banking system. And in the insurance sector, following the completion of licensing, we are now developing a framework for ongoing insurance supervision.
Well, happy to answer any questions, so please.
Governor, you note the long-standing vulnerability from our high level of net foreign debt, and I'm wondering what the Reserve Bank could do or should do to mitigate that risk.
Well, if you're talking, Brian, you're talking external debt.
Yes.
If you look at the ratio of net liabilities to GDP, it's currently around 66%. Now, that's one of the higher ratios in the OECD. In fact, some of the countries that are higher than that have been countries that have got into difficulty around the global financial crisis. But a lot of this debt was run up in the period in the early 70s through to the mid-80s. So really after the first oil shock and then taking in some of the think big debt. So that if you look at our current account position, which is the sort of flows that lead to the stock of debt, and you start digging into that, then you find that we've been running surpluses on the merchandise trade balance for much of that period since '84. We went into deficit with the Asian financial crisis in the late 90s, and we also went into significant deficit, probably I think around 2005 through 2007. But by and large, we've been running surpluses on the merchandise trade balance. So a lot of the debt that built up has occurred, as I say, through that period since the first oil shock through to the mid-'80s. But in essence, if you say, well, what causes current account deficits, then in essence it's a reflection of total savings relative to total investment in the economy. And the easiest way to simply think about it is that as a country, if you look at national savings, we do not save enough relative to our desire to invest. And so we therefore require foreign savings to meet those investment needs. And that's what creates the current account deficits that build up the level of debt over time.
Should it be any part of the Reserve Bank's responsibility to affect saving behaviour other than through interest rates? I'm asking obviously about Labour's policy.
Yeah, I'd rather stay away from talking about Labour's policy. We're very keen to ensure that the bank continues to be as apolitical as possible in quite a tricky election environment.
Mr. Wheeler, you say that house prices are overvalued. Could you give us a sense of how overvalued you think they are at the moment, and what might spark a fall to more realistic levels?
It's not just the bank, James, that think of house prices as overvalued. It's also the OECD and the IMF and the three major international credit rating agencies. But the OECD did some work recently that was, I think, quite interesting. It basically looked at the household, basically house prices relative to household disposable income. And New Zealand is high by international standards on that in terms of that ratio. But in terms of our historic patterns, we're currently, according to the OECD, about 26% above the long-term average for New Zealand in respect of that particular ratio. And the OECD also looked at the house price to rent ratio and found that we were currently 66% above the long-term average for New Zealand. So there are two indicators which I think give an indication of the potential degree of overvaluation. What could cause it to moderate? Well, loan-to-value ratios are starting to moderate the rate of house price inflation. Interest rate rises will help do it as well. More supply will certainly help. And if you look at the housing needs of Auckland and Christchurch, for example, over the next 3 to 4 years, it's something of the order of 50,000 houses in total. So to the extent that those get built, then that will help to moderate the pressure. But equally, if growth slowed in the international economy, or particularly in China, then that would start to feed through to the New Zealand economy, the Australian economy, and also affect the demand for housing as well. But let me see if Grant wanted to add anything.
No, I think that covers it, yeah, but our concern was always that if those price multiples continued to increase, then New Zealand in the housing market in particular would be much more vulnerable to an external shock, such as to the financial sector or coming from China.
You talked about late this year being the earliest you could, the earliest date for beginning to remove LVR restrictions. Does that imply that you're thinking of some phasing out rather than now you see it, now you don't?
Yeah, so we did say very clearly that the LVR restrictions were a temporary measure. We see them as a temporary measure. But I guess we're keeping our options open in terms of how and when the removal occurs. So yes, it's quite possible that when we do come to remove the LVRs, that they could be phased out rather than moved out in one hit.
Given the long-standing housing issue, the long-standing savings issues, and also the overinvestment and the house price, the high price issues, have you given any consideration to actually keeping the LVRs there indefinitely?
Well, when we did the analysis of the impact, it's apparent that really the impact, most of it we would think would happen over the first year that the restrictions were in place. And then the longer you keep them in thereafter, you tend to get more of the negative side of such restrictions, the potential distortions, potential disintermediation. So even though we have seen that in other countries, where other countries tend to bring these things in and then and leave them there, we want to keep to the discipline of committing and doing what we say. In other words, that they would be a temporary measure.
I noticed as well that since they came in, and particularly since the start of this calendar year, the credit growth in consumer lending has taken quite a upturn. And does that suggest that some stuff's being funded off that rather than house lending officially for households and mortgages?
Yeah, well, we've looked at that, but we don't really think it's a significant factor in terms of undermining the restrictions. Because at the same time, retail spending, in particular things like automobiles sales, have increased. And so we think that increase in consumer credit is more linked to the increase in vehicle sales than to people using cards to fund a housing deposit.
You've said that one of the things you'll think about in terms of this decision is you need to be confident that net immigration isn't causing a resurgence in house prices. And given that a lot of economists are expecting a peak in that cycle not to occur until late this year, how confident will you be able to be late this year about the housing market effects?
Well, we just have to monitor the indicators and developments through the year. So we'll be monitoring the immigration flows and the pressure that's having, but also obviously looking at the various indicators around the housing market, how well the supply is coming on stream, but also what's happening on demand side as well, and prices and price to income ratios that we mentioned in the report. So it'll be a mix of factors, but clearly the migration flows are going to be an important factor. I think the main two sort of offsetting factors are potentially higher interest rates on the one hand, tending to slow things, and migration inflow on the other, which is tending to support the housing market.
The migration flows have been stronger than we forecast, and I think most forecasters around town envisaged. I mean, if you look at migration, net migration's running at around 30,000, 31,000, I think, from memory, in terms of the annual flows. Our forecasts that were in the March monetary policy statement had it peaking at about 36,000. Now, we may well be surprised around that, but we'll need to watch it very, very carefully.
Given that migration flows could go potentially to 40,000 by the end of the year, why would that be any different to what we saw a decade ago when similar levels hit New Zealand and we saw house prices take off?
Well, I think, we did see strong migration in about 2003, and it did put a lot of upward pressure on the housing market. From memory, I stand corrected, but I think those net flows were in excess of 40,000, maybe around 45,000 or thereabouts. But, this time we've moved on the loan-to-value ratios, which we think, as I say, are having a moderating effect on house prices. The banks have come in below the 10% speed limit that we talked about. I mean, if you look at high LVR lending system-wide over the past 6 months, it's averaged around 5.6%, so it's below the 10%. We've started an interest rate tightening phase. So, there are good grounds for thinking that that house prices will continue to moderate over time.
Just on the migration projection, I mean, not sure if there's anyone here from economics who's close to our forecast, but the forward outlook is very much a function of the outlook for our economy, and the Australian economy is very important as well. So the greater the prospect for the Australian economy and recovery in the labour market there, then that will have a significant bearing on the net flow between the two countries and the extent to which that peak comes off during the year.
You mentioned in the Financial Stability Report the potential risks from some sort of slump in the financial system in China and property prices. Can you give us a sense of how much of a risk you think this is and how it might affect New Zealand if it does happen?
Well, I think it's one of these sort of looming risks that you need to take note of and watch very carefully, because it's one of those things that I think is quite a high likelihood that there will be some sort of correction, particularly in the China financial markets as they go through their deregulation and reform program. At some point is likely to be a disruption in the financial sector and some sort of probably temporary pause in their long-term growth track. But picking the timing of that is incredibly difficult, and it could be a year away, it could be 5 years away, but my view at least is that there's quite a high probability it will occur, but I'm not expecting anything in the near term.
If you look at some of the work that was done by Fitch, the rating agency, I mean, basically they said that the assets in the broader Chinese banking system had expanded roughly of the order, I think, $16 trillion over the past 5 years, which they said, if their analysis is correct, they said was equivalent to what had taken the US financial system 235 years to achieve. So you've seen very, very rapid growth in debt in China, particularly to the local authorities. And the third plenum reforms that were announced were tremendously ambitious, probably the most ambitious in China the most ambitious, I'd say, in 30 years. At the heart of them is financial sector deregulation. And the challenge for China will be that no other country that has undertaken financial sector deregulation and liberalisation has had to do it when their economy is growing at something like 7.5% real. If you look at the experience of the European countries, our own experience, those of many other OECD countries, you saw two things. You saw you saw financial disintermediation, and you saw a lot of financial innovation. And you can think about it because a lot of controls have come up. The ability to innovate is open to a lot of competitors, and that led to very rapid credit growth in pretty well all the economies that went through this process. Now, as I say, no economy has had to do this when the economy's been growing at around 7.5%. So it's going to be a huge challenge for the Chinese authorities, particularly with the sort of debt explosion that's occurred in the last 5 years. So it's something that we follow fairly closely.
And the way that would affect New Zealand if it were to happen?
There's essentially two channels. One's the trade channel and one's the financial channel. On the trade side, clearly they're a major customer of New Zealand, particularly with the dairy trade, but also agriculture more broadly. And so any impact of financial disruption on growth and demand is going to affect commodity prices and export receipts. But then on the financial side, while we don't borrow funds from China, any disruption of that sort is going to have a major impact on the international markets generally. And New Zealand, as Graham mentioned at the outset, is very dependent on the international financial markets for funding. So that would be the other channel of disruption.
Given that something like 30% of farm debt is held, you say, by 10% of dairy farmers, prices are already falling, and there's the risk you mention. What's your level of concern about that concentration of risk?
I mean, if you look at dairy debt, it's about $32 billion, and it's by and large almost trebled over the last decade. But in the last 2 or 3 years, it's flattened out a bit. The tricky issue, I think, is 50% of the debt is owned by 10% of the farmers, and that leaves them vulnerable to if there were to be significant reductions in the milk price payout and declines in international dairy prices for dairy products, and if that started to feed through into the price of farmland and that sort of thing. What we have seen is that we are seeing a lot of new building permits, a lot of farm development taking place amongst dairy farmers, but you're not seeing a rapid increase in credit to dairy farmers, lending to dairy farmers. I think from memory that's running at around 5% or thereabouts. So it does suggest that a lot of the expansion works that are taking place on farms are taking place through retained earnings and the high incomes that are being generated in the dairy sector.
Just back to China, I just wondered, Treasury just recently in one of their economic indicators monthly surveys pointed out that they seem very sanguine about New Zealand's growing reliance on China. It appears to me that you seem to be more pessimistic about that. Is that a fair assessment?
I wouldn't say pessimistic. I mean, if you look at Chinese share of our exports, it's gone from 3% to 21% over the last decade. I mean, that's 18% increase in share is really quite phenomenal. And I gave and if you look at, there's I think a graph that we put in the last monetary policy statement that showed the proportion of primary exports going to China. So, for example, China is the main market for all our primary agricultural exports except dairy, with our number 2. So it's a tremendous thing that we've got the opportunity to take advantage of China's rapid growth. And particularly the expansion of the middle income class there. I talked in a recent speech about dairy exports and whether we needed to diversify further, and talked about India as being the market, for example, that according to the Australian Bureau of Agricultural Research was expected to really open up in the next 20 to 30 years, so much so that the expansion in global imports coming out of India would be something like 3 times that of China by the year 2050 in terms of the broad projections that they're done. But I think there's lots of opportunities out there. I mean, you look at what's opening up with free trade agreements that are currently being negotiated. You look at the Trans-Pacific Partnership, if that comes off, the opportunities there. You see the rapid growth in middle-income countries. So I'm not concerned about the growth of China as a main export consumer now, but I do think we do need to continue to look to diversify. Just as Grant said, if China gets into trouble, it would affect Australia very significantly. And while China takes about 22% of our exports, or 21%, Australia is pretty close to that same percentage. So that's the challenge we face.
Just on that though, Graham, do you think that enough attention is being paid by other policymakers in New Zealand to some of the concerns that you've expressed there about China's financial system and its vulnerabilities?
I can't speak for other policymakers, but it's something that we look at very closely here. We follow it. We follow it as closely as we can. It's often a subject in our Monetary Policy Committee discussions, for example. And we have someone who works, a couple of people who work pretty intensively looking at the financial system there.
Just going back to LVRs, I guess the concern was raised earlier on that this would shut out first home buyers from the market. What evidence is there that those buyers have been blocked from getting into the market?
Well, the share of first home buyers has reduced in terms of the sales figures. That was there was a graph of that in the speech I gave last week. But I mean, the key is that, you know, in terms of, clearly there's been an impact at the lower end of the market from LVRs more than at the upper end of the market, but there has been an impact right through nevertheless. And at the end of the day, our observation is that, you know, we're targeting high risk loans, not loans of any particular sector. And so high LVR loans, there's a greater proportion of high LVR loans with first home buyers. But, you know, that's a significant part of the market, and at the outset of this, we said it was just not a realistic proposition to have any exemption for that sort of segment. So if we're going to reduce risk in the system, which is the objective of the LVR policy, then it is going to impact those borrowers that are more stretched, relatively speaking. And some of the first home buyers come into that category.
The figures in, I think, Box A do seem to suggest that the impact has been disproportionate in the lower price end of the market, hasn't it?
Yes, that's right. So the sales reduction in sales figures from peak through to March were about 11% overall, but yeah, for the lower categories it's probably more like 20% reduction.
Do you think that is distorting the traditional measures of house price inflation and skewing them upwards?
We think that is correct, yes. Even the Rhines number, which is a stratified index, we still think there's some upward bias in that. So that if it was measured accurately in terms of the price effect would probably be greater than the 2.5% that I mentioned earlier.
Do you have any estimate of what the real figure might be?
No, we haven't. We're sort of looking into that, but we don't have an estimate of that bias at this point.
I mean, we believe the QV house price index is probably...
We've got a microphone for Bernard here.
We believe the QV house price index is probably a more reliable indicator of house price inflation. Of course, that's available with more of a lag than the Rhines series. So, but we do look very closely at that measure.
Just on that LVR data that you released, where you showed a 6-month snapshot of what happened, I know that the LVR lending was well below the 10%, but I think that the new lending from banks' new lending, total new lending, jumped from like February to March quite a lot. So that obviously means that banks are able to lend more under the LVR restrictions. Is that something that you're keeping an eye on?
Yes, we're watching the monthly developments, obviously, but yeah, so the proportion of high LVR lending came down to well below the 10% speed limit. So we would expect, now that the banks have got used to running this system and making sure that they stay within the limit, that they'll be able to move up and be a bit closer to the 10%. And I think the banks are probably doing that now, sort of, rather than just shutting off the tap as they did to start with. Now they'll be, getting a bit more of the high LVR lending out there. But we don't think that's going to have a major impact on the overall credit aggregates, which are slowing.
The report notes that the LVRs have had a bigger impact on home sales than you expected, and I'm wondering whether you think now that there could be that they may have a bigger impact on house price inflation than you'd expected, and to what extent that might feed into this broader picture of slower general inflation.
Well, you're right, the sales reduction is probably greater than we expected, but the price impact is pretty much in line with the range that we talked about, and similarly with the credit overall impact on credit growth. So we're happy that it's pretty much in line, because these things are never very precise, obviously. And so, we want to just monitor that through the rest of the year, and watch to see, if that moderation stays in place, and consider the impact of those other factors that we talked about earlier.
As Grant said, we did some modelling work, trying to look at the counterfactual of what might have happened if the banks had continued to make 25 to 30% of their loans to people with low deposits. And in a recent speech, Grant mentioned that we felt that house price inflation would have been around 2.5% higher. So if you look at quarterly moving average, annual moving average on a quarterly basis, that's the way I should probably put it. House price inflation for New Zealand's currently running at about 8.4%. So we think it might have been running at around 11 in the absence of these measures. Now, the modelling work that we've done on that, we've written up in an analytical paper, and I think we're putting that out in a couple of days or so. So that may be of interest.
You've mentioned that you expect the speed limits to stay in place until the housing market comes back into better balance. What sort of indicators are you looking at to measure that balance, and how might we know that it's there?
Well, things we've already talked about, in particular house price inflation, and in the report, we mention house prices relative to incomes, for example, debt relative to incomes, in terms of mortgage debt, as well as the progress that's being made on closing the supply gap. We talked about there's 50,000 houses, what progress is being made towards reducing that number. So, yeah, overall measures, and of course the other big factor we mentioned earlier, migration, in terms of how that's running relative to our expectation. All of these factors are going to come into the mix.
And also how we think that the interest rate tightening is affecting the demand for housing as well.
With your interest rate hikes and the LVRs and other restrictions, and coupled with potentially a slowdown in China, do you see any risk at all in pushing the country into a deflationary cycle?
No, I don't think so. I mean, we've said previously that we will feel our way through this interest rate tightening phase. And we've tried to be pretty transparent in terms of our forward projections and the speeches that we make around how we're seeing the economy and also the need to tighten interest rates. The complication is that we're having to do that when no other advanced economy is likely to tighten interest rates this year. So we clearly look at the exchange rate. Look at the exchange rate implications, what effect that might have. We also are very conscious of the fact that, there's a whole generation or a large group of borrowers out there who are highly leveraged and have never been through an interest rate tightening cycle. So, what effect does that have on their consumption spending, their behaviour in various ways? So there are some of the things that we look at when we make judgments about the phasing of the interest rate tightening. Very much feeling our way through it.
Governor, what's the thinking behind introducing the bank stress testing now, and sort of what are you hoping to achieve by introducing the stress tests?
Well, it's it's not something that's totally new. I mean, all of the banks themselves use stress testing in a regular way as part of their risk management framework, as part of their assessment of the capital adequacy. What we want to do is try and have a more consistent and comprehensive framework across the banks so that we can run regular tests on a comparable basis and make more sense out of the results across the banking system. So we have run stress tests in recent years in collaboration with APRA for the major banks in particular. And so we've had these sort of one-off exercises from time to time, and what we want to do is, rather than just having these sort of ad hoc one-off tests, we want to have a more consistent sort of comprehensive framework, and just as another tool in the toolkit of prudential management of the banking system.
To publish the results or the broad results of that, and perhaps the financial stability reports?
Well, we would expect to certainly comment on them and publish certain aspects of the results, in particular sort of aggregate results. But we wouldn't be looking, and you're probably thinking about some of the stress testing results that get published, for example, in the United States and Europe, where they are quite public about the outcomes for individual banks, and in some cases where some banks are having to go very quickly to the capital markets to recapitalise or to get up to the adequate level. And it's not our intention to follow that model. We're not wanting to make this sort of a headline, sort of a focal point of our relationship with the banks. It's something that we'll report on in aggregate, but in large part the individual results will be part of our relationship with the individual banks themselves.
Does that feed into the open banking resolution and sort of trying to aggregate or create a benchmark information across them all?
Well, just for us and the banks themselves to better understand the capital adequacy in terms of what sort of capital base the banks need to withstand possible shocks to the system.
So, Grant, just further on that, I just wonder then, are you concerned that because you've not been able to compare across banks necessarily, that there may still be some nasty surprises in there that you're unaware of?
I don't think so, no. As I say, we have the banks themselves do their individual exercises, and we've done these joint exercises with APRA, where we've generally come out with positive results. And we have reported on some of these actually in previous financial stability reports. And they've generally been, pretty benign outcomes. So we're not expecting to unearth any nasties because, we talk to all of the banks on a regular basis, and we have various sources of, assessing their soundness.
Just on the stock take of the regulations as well, have the banks been expressing some concern that they feel like they've been overburdened with regulation?
Well, the industry, you'd have to talk to them on that, but I guess they have been feeling the regulation. There's been a lot of new regulation over recent years, and that's a true observation internationally as well as in New Zealand, because post-GFC there has been, quite a shift with Basel III and various other aspects of additional regulation. So since the GFC, we've been through 5-6 years with quite a few different additional new regulations in place. So we think it's time to sort of just take a pause and say, okay, well, let's review all those regulations and see if there's any redundancy or any improvements that can be made, not to fundamentally change the shape of the regulation, but to see if the job can be done more efficiently and more simply.
Certainly, if I just look at that box in box C in here, it would seem to indicate that you seem to think that the system is running fairly well.
Yes. Our overall assessment is that the system is sound and indeed pretty efficient.
So you wouldn't be expecting any major change at this time?
Major change?
If after your stock take?
No, well, we would expect to be, to make some changes potentially, but we wouldn't expect it to be a major shift, no. It's more in the sense of a tidy up and removing things that might be redundant.
Is there any particular examples you can give?
Not at this stage, Patrick. I think we're really just at the beginning of this process.
Just one last one from me on the potential phasing out of the LVR limits. What form might a phasing out take, and in particular, could it be a lifting of the speed limit?
Yeah, if there was a phasing out, that's the sort of thing that we would envisage. The speed limit's currently 10%, and that could potentially be lifted to some interim stage before it's removed.
Any idea how long that phasing might take?
No, we haven't given that consideration yet.
Well, thanks very much indeed.